This is the Forecast Free series from the Resilient Advisor podcast. Today is October 18th. My name is Jay Coulter, and my partner in this series is Clint Sorenson, the Chief Investment Officer of Wealth Shield. Clint, let's get right to it. Let's talk about whether these items are legitimate concerns for people building portfolios today. Talk us through BREXIT.
Other than major currency fluctuations, the volatility around those currency fluctuations, at the end of the day, I don't see it as a big issue when constructing a portfolio. At the end of the day, it's just more of a symptom of underlying populism and the rise of populism that we're seeing throughout the geopolitical landscape. And I think it's more just a symptom of that than anything indicative of changing the portfolio.
From a valuation perspective, where do you see that affecting the continent and, anybody who has exposure to single country ETFs in that space?
I really haven't thought about that in terms of what that could do to affect that. Look, if you look at Europe, Europe's got at super cheap valuations relative to the US and to a lot of the rest of the world, especially when you get into Northern Europe, emerging markets as well. So, the value play has been in the international space, and it continues to be there in terms of looking to find where at least expected returns could be better than what you're going to have here in the US. But I haven't really thought about how that's going to necessarily affect it, nor do I know if it will over the long term, because valuations are really a long-term mean reverting deal. That mean reversion happens between 7 and 15 years, not necessarily over the course of a news event.
So what about the dividend seekers? So dividend paying securities over in Europe right now, you're getting a really nice yield. Do you have any thoughts around adding that to a portfolio for these US-based investors who are biased towards the US-based companies? Can we get better yields over there now?
Absolutely, better yields. I think you got to be careful about value traps, though. So I don't like yield-seeking behavior, and the reason why is because we find better strength in companies that increase that yield on a consistent basis. Sorry, there was a trash truck on the back end. You might want to cut that one out. The yield seeking, the higher yielding companies can sometimes be value traps. That doesn't always work out in the favor of the investors. So I tend to favor looking at companies that are solid fundamentally, that pay dividend yields, but more importantly, have shown a history of increasing those dividend yields throughout various economic cycles. So great way to stress test your portfolios. Go back and look at what happened during when Greece went under. Look at 2012, look at 2015, 16. And when you're looking at these companies, study their dividend history throughout that period. You find companies that are increasing their dividends during that turmoil. That's probably a pretty good sign of stable balance sheets in a high-quality company. And so I do like that as an incorporation into a portfolio.
For the U.S.-based advisor that probably doesn't have the resources to go build an individual stock portfolio, will ETFs cover it?
Yeah, ETFs will cover it, and I think you want to look at try to find some dividend growth or some value plays is what I would look for in that area.
All right, let's keep moving east. China, growth is slowing. Do you believe the numbers? I already know the answer to that. What are your thoughts on China? And more importantly, from an investor's perspective, what do you do from an allocation standpoint now?
Yeah, China, look, they're the second largest economy. We're going to see amazing growth over there, especially in the A-share market as they open up mainland China. But at the end of the day, you still have growth slowing over there. So when you're looking at factor exposures, growth's been slowing over there. So you want to stay focused on that low volatility, higher quality themes in China. And you want to stay in those sectors that are rather defensive because, globally growth slowing, and sure, we may get a rebound, but no one knows the magnitude of that rebound. So my opinion is, as long as growth's slowing, you got to be defensive.
For a U.S.-based advisor seeking allocations over there, does it make sense to target China exposure specifically or use a broader index that will obviously have a lot of exposure to the mainland?
I actually like carving China out completely. So I like doing emerging markets ex-China. Mm-hmm. There's several funds and ETFs that do that now. And then carving China out almost as its own asset class, right? Because it's not really emerging, and that's the indice that it's in typically, and it dominates those indices. So at the end of the day, I like carving it out, getting emerging markets ex-China, and then allocating to China more of an opportunistic fashion where you can kind of isolate either some of these factors you're looking for or take positions in things like Chinese tech or traditional Chinese A shares. So I think there's a lot of opportunity using ETFs to be able to build a pretty cool allocation where China is a focus and separate from your emerging market exposure.
I like it. Let's wrap up on factors. Let's come back to the U.S. What factors do you see being effective right now? And now we don't forecast, but based on what you see now and from a historical lens, what should we be looking at as we wrap up the year and head into 2020?
Yeah, so if you look at the business cycle environment, you really have 4 stages. You have early acceleration coming out of a recession, late cycle acceleration, which is what we had in 17, early cycle slow or late cycle slowdown. So an early slowdown, that's where we've been since October of last year. And then you have a contraction. So if you look at where we are from a economic standpoint with both growth and inflation slowing, you want to be in that high quality, low volatility. Though you want to be in those factors. Now momentum, you can also be in momentum because momentum is rotated to those factors just naturally because they've been the top performing. So you could actually throw momentum in there as well. If we do go into a contraction, the only thing that would change, you want to keep those factors still represented in the portfolio, but you can start looking at value. And I think value starts to really take on some leadership in that contraction. So right now, low volatility, high quality, and sprinkle in some momentum. If we go into a contraction, I would start looking at value.
Excellent. I appreciate you doing this from your hotel room. I know you need to run to
Absolutely.
the airport. We'll see you next time.
Yeah, absolutely. Thanks, Jay.
The information provided is for educational and informational purposes only and does not constitute investment advice and should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult an attorney or tax advisor. Resilient Wealth LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Resilient Wealth and its representatives are properly licensed or exempt from licensure. For Resilient Wealth information, please visit Investment Advisor's public disclosure website at www.advisorinfo.sec.gov by searching Resilient Wealth CRD number 301986.